Okay, welcome everyone to the SRP's first webinar on structured products. I'm Garbo Chung. I'm the listed structured product champion from the Hong Kong Exchange and your moderator today. So our webinar today is about leveraging structured products in a pandemic world. The global spread of COVID-19 has resulted in extraordinary high levels of uncertainty in the financial markets, and in turn, the structured product market generally. In this webinar, we have invited industry experts to talk about the challenges they face, from investment counseling, client engagement, to product issuance, and how technology has helped in front-to-back operations. With me today is a panel of 4 speakers, Mr. Ishan Sarkar, Head of Structured Products Southeast Asia from HSBC Private Banking, Mr. Edward Liu, Managing Director, Head of Investment Counseling from EFG Bank, Mr. Terry Zhang, Executive Director, Head of Sales from Vontobel Limited, Mr. Erdem Ozglu, Managing Director, South Asia from Numerex. Okay, now to our panel speakers. We have seen some of the most severe market conditions ever experienced. The impact is across virtually all asset classes, and volatility in structured product pricing has been pronounced during the past few months. The massive volatility have also brought huge opportunities and significant inflows for structured products. So while the market is navigating through the crisis, how will business look like in the post-COVID world? What changes the scene, such as the way we operate our business and how customers behave? How are we adapting to the new normal? So let's start by asking Ishan about the challenges faced by private banks and what opportunities lie ahead for structured products in this space.
Yes, thanks. This is Ishan here. Very warm welcome to everyone, and I hope everyone is safe. So yeah, it's been quite challenging for the entire world, not just from the economic point of view, in the past few months. And needless to say, we have never seen such kind of volatility in the market in many decades. And structured products as product has also been hit quite significantly. One of the greatest challenges which we faced in the private bank was the movement of the views of the market, from one extreme to the other extreme. I mean, if you look at the second week of January, when people were talking about Fed trying to raise rates throughout the year, from there, if you go to just 1 month down the road now, when people actually talked about the Fed fund rates being zero, that has a significant impact in terms of structured products, because you end up selling and marketing a lot of structured products based on these house views. And when your house view change from one extreme to the other extreme in a span of few weeks, it's a very challenging conversation to have with clients. And that's something with the private banking industry faced significantly, and the same with other asset classes as well. The massive movement in terms of the underlying prices also had an impact in terms of the mark to market, which actually subsequently led to margin calls and client positions. Again, a very difficult condition to be in. And the other aspect of it was the illiquidity. We actually saw the bond market freeze up completely. And I think this is where probably structured products was slightly better, because while structured product is supposed to be an illiquid asset class, we did see that during the extreme market volatility, when something as simple as cash bonds freeze up, you could get some kind of liquidity in the structured product market. But I think the most important issue we had was client holding, the hand-holding of clients to help them navigate through this situation. And various different banks, very different private banks have used different ways. And I think the most common way was, you need to call up the client and tell them exactly what the current situation is. And I think to be fair to pretty much all the clients, they understood that we were in a very extreme situation, and that's why we are here where we are. So what was also made tough is because of the lockdown which was imposed in a lot of countries and a lot of cities, which meant that communication became overnight. It became digital. You couldn't just meet the clients. You couldn't actually meet colleagues. So this client hand-holding became a very important feature in terms of how we actually navigated through that phase. But having said that, as Garbo mentioned, that I actually believe that this heightened volatility and uncertainty also brings in a tremendous opportunity in structured products, something which we actually have seen in the past few months. So, contrary to some of the other asset classes, structured products has seen tremendous inflows in the past couple of months, and there are various factors to it. The number one factor would be the yield. The finding yield currently, in any asset class is going to be extremely tough and challenging. And I think people realize that structured products is one way where you can still generate yield, and some of the bread and butter structured products like fixed coupon notes and equity linked notes has turned out to be a huge sensation among the clients. And in HSBC, we have actually seen clients who have never done structured products, have been predominantly fixed income clients, now looking at structured products to raise the yield. The other aspect, obviously, high volatility. There's a common saying in structured products that volatility is your friend. So every time you have high volatility, you do see a lot of interest in structured products simply because the pricing becomes very attractive. For the same parameters, if you've got a high volatility, you get a much higher coupon, or you get a much higher participation rate. And that's why going forward, while the VIX has come down from 82 to 35 currently, I don't think the VIX is going any down to about 12 to 15, which is generally where VIX tends to be in the near future. So we think this heightened volatility will continue to see, growing interest in structured products. And my second last point is the asymmetrical market movement. Now, we have seen a huge run in terms of the equity market. So if you look at S&P, it has had a huge bull rally since March lows. But if you really peel the onion, you'll realize that there is a huge asymmetry in terms of how the market has moved. So the market has moved because of your tech and healthcare companies, which have actually taken the bulk of the movement up. So we will continue to see this asymmetrical market movement. And for a client to be able to access this asymmetrical market movement, you would need esoteric payoffs. And that's where structured products is going to play a much larger role in the client's portfolio in the future. Lastly, as we enter an environment where we think that while we do see the equity market stabilize to a certain extent, we're not sure we're out of the woods by a long shot. Here, a particular kind of structured products, which will play a very important role, would be the market neutral payoffs. We have already seen market neutral payoffs like outperformance and dispersion playing a huge role in clients' portfolio in the past 1 year. And where we are, this is actually a great opportunity for clients and the private banks to look at this market neutral, because you kind of take the market view out of the picture, and it actually boils down to your asymmetrical market movement theme, where having a market neutral payoff acts as a great overlay to your overall equity portfolio. At the same time, I think it also, this current market scenario has also showed the importance of hedging. I think historically speaking, private clients have been a bit hesitant in paying premiums for hedging. We have seen heightened activity in terms of hedging towards the end of last year, when equity markets are at an all-time high. And any and every client who has done these hedgings, has put those hedgings in the past, in the past 1 year, has seen how important hedging is. So hedging is going to be a conversation which the clients is going to have a lot more often, and that's what we already see in HSBC Private Bank with our clients, where clients not only want to hedge their equity portfolio, but also want to protect their profit. So selling their profitable exposure and buying a call option. So overall, Gabo, I think this current pandemic does give a lot of opportunities for structured products. Structured products is going to be even more relevant than what it was in the past for the coming 12 to 18 months.
Okay, thanks, Ishan. I think, well, I could imagine how difficult business must be operating under the extreme market movements and change in market views overnight. So, but it's great to see that there are a lot of opportunities in the structured product space. Now, let me turn to Edward, because Edward is an expert in investment counseling. Can you tell us a bit about client engagement, especially with the vast majority of structured products falling under the complex product regime? How can you ensure client suitability, product due diligence, and best execution, while you are not able to see the client face to face?
Hi everyone. So firstly, thanks Gabo for the questions. Obviously, during the pandemic crisis, the investment counselors is the front lines, and we face a lot of stress, obviously, because every day we're seeing the equity markets having circuit breaks, and the OTC market on the bond side that Ishan also mentioned was actually had experienced a significant meltdown. So for us, being at the forefront to engage clients, we actually have to be very proactive and hand-holding with them, talking to them about what the markets situations, explain to them why it's like this, and obviously, as we are facing different kind of clients, and depends on what the clients have done prior to the crisis. Sometimes the conversation could be a little bit different. Obviously, for clients that reducing some of the risk, take some profits or from the portfolio. Actually, these opportunities for them is quite good because they, the conversation goes more managing about their expectation, when they can actually sit and wait for opportunity to arise and then get back to the market. But obviously that there are clients actually still retain some risks in their portfolios, and particularly if they have leverage in their portfolio. And then the for us, for the investment counselor, they actually have to helping the clients on the risk management side, be it to trim down some of the position, raising cash, and or maybe helping them or convince them to transferring certain assets to support the portfolio. And I think that is really a time to test also, as you actually mentioned about client suitability. I mean, we have to think about, what sort of assets will need to go out of the portfolio first, and what sort of assets that actually providing liquidity that is easier to raise cash, and of course that also testing the execution side, because not sometimes when certain asset becomes the bid offer spread becomes very wide and may not necessarily be the good timing to exit certain positions, and also once there's liquidity, it is important that we work with dealers very efficiently to make sure that the position are being offered. So yeah, so I think that is definitely a very stressful time for the during the crisis. And I think for structured products, it was I think this time around the liquidity provided by the issuer is quite good. We actually don't typically experience the some of the illiquidity observed in the bond market. So the issuer were, even in abnormal market, was able to provide liquidity on a structured product, and that actually given more confidence to the investors to engage structured investment. And also because structured product is a way to modify the risk return profile, and actually prior the crisis come, there are we are actually positioned some of the market neutral strategies for the clients, be it on some dispersion trades or switching into some sort of principal protected products that to roll into the some of the profit that the clients is taking, so that those actually giving some sort of good protection for the clients to in this kind of crisis. And then of course, beyond, I think now the after March, end of March, and the market start gradually stabilize with the Fed coming with and also other central bank coming with a lot of liquidities. Then the volatility stay high is actually a good opportunities for us to re-engage clients with investment opportunities. And this time around, we observe that the clients are more receptive to structured products. Be it on the one hand, despite a lot of talks about the market direction, different kind of scenario about the economy turning around, still investors are concerned about what the market is going to go. But with structured products, typically in the private banking world, we see a lot more selling volatility, so the product being sold, and with very high volatility actually providing quite a bit of a protection after the market has already corrected very significantly. So we see more investors actually going into making use of structured product to form their portfolio. So that I think is quite a bit of change, and I think that even though the market has rallied for a couple of months now, VIX has come off quite a bit, but still I think there's still some value there, and it's quite favorable for the structured investment. Yeah, I think that is how our experience been with the clients during this very abnormal time.
Okay, thank you, Edward. I think echoing on what Edward said, there are risks and opportunities for clients to use structured products in their portfolio. Next, we turn to Terry. Terry runs the private placement business of structured products for Vontobel. Can you tell us a bit about how payoff structures, choice of underlying were affected in response to the uncertain market environment? And what challenges are structured product providers facing, and how will they evolve post-COVID?
Certainly. Thank you, Gabo, for the questions. So basically, the current environment is characterized by elevated volatility and low interest rates, which is a bit tricky for investors to navigate. As Ishan pointed out nicely, this crisis has turned into unprecedented opportunities in structured products. And these products are meant to offer you a tailored risk-return profile and can be made flexible for all market conditions. And specifically, under the current environment, we would educate our clients by showing some additional features that would mitigate the downside risks or increase the chance of early redemption. And other than that, for those bullish investors who worry about the risks of missing out on a runaway market rally, as we have seen in the last couple of months, they could also use the premium from selling the put options to fund the call options to enhance the upside exposure, which is also a smart thing to do. And given the low interest rates, a full principal protections is no longer possible, but partial protections is still doable, although the terms are not as attractive as what you have seen a year ago. So basically, in summary, what we have seen in the past few months is not any groundbreaking new innovation, but rather a tweak or some add-on features on existing yield enhancement structures. In terms of the choice of underlying, I think there are two aspects to consider. You can look at it from a pricing angle, but more importantly, it's all about the investors' views on the underlying stocks. From a pricing or structuring point of view, one of the key elements in the pricing of structured products is the dividend. Earlier this year, we have seen the most aggressive dividend cuts, particularly in financial and energy sectors, which had been popular underlyings for structured products in the past, but now they have become much less attractive. Also, most investors would expect the post-COVID world to be more digital, and certainly that will affect their choice of underlying as well. And going forward, their preference on new economy stocks or tech names in general, particularly those involved in robotics, automation, or companies that could benefit from digital transformation, will likely to continue. And besides being more digital, the post-COVID world could also become less global, as we are talking about deglobalization here. And this implication to the investment is that in the past, we used to have stocks listed in US or in Europe or in Hong Kong, but they really have a substantial global reach. So you can get a bit of a diversification benefit from the global mix of businesses. So as investor, you could still choose to diversify globally or invest in those global companies and benefit that indirectly. However, I think in the future, it would be imperative to have global diversification in order to capture the opportunities in different parts of the world as more and more businesses becoming domestic centric. And in terms of the challenges that we face during the COVID and how they evolve in the future, I think from a distribution point of view, the challenge was on how to maintain client engagement during the physical lockdown. But thanks to our technology and our digital marketing platform, our advisory effort has not been reduced. And in fact, we managed to have more airtime with clients through various digital channels. And clients appreciate the fact that we are there for them during the uncertain times, and such human touch in turn provides our clients the comfort level needed to trust and have confidence in our products, in our platforms, in our services. I guess what I'm trying to say is that this crisis has created a testing ground for us to find a right mix of technology and human element to deliver the best client experience possible in good times and bad times. This COVID-19 has presented many challenges to us as providers, and in such volatile markets, it's even more important for us to stay close with our clients, understand their needs, because at Vontobel, we understand that none of our clients would need another bank just pricing more aggressively. In order to stay ahead of the game, or at least stay in the game, we need to ensure we are always relevant and connected with our clients.
Thanks, Terry. I think you have brought up a very good point. I think we need the right mix of technology and human elements in the post-COVID world to stay in and even ahead of the game. So now let's turn to Adam. Maybe can you share with us your views on how technology has helped in the structured product market during the crisis? So say, for example, not just for from the shift to remote work access, but also in terms of front office trading and execution to back office operations in both buy side and sell side firms.
Yeah, sure. Thanks again, Garbo, for the great introduction, and also Terry's last comments kind of provided the lead way in terms of the technology discussion. So the clients are not looking at only technology stocks in terms of the trend with the transformation in digitalization, and it's not in the only traditional industries. We started seeing this significantly in treasury capital market space, especially when it comes to derivatives and structured products being heavily invested and traded in Asia or overall in emerging markets economies. Prior to the COVID, we've started already some shift in terms of financial institutions started investing in their technology, digitalizing, transforming, moving away from legacy technologies, on-prem usage to more cloud-native, hosted and distributed services. But it was still slow pace and it wasn't the norm. And what we couldn't achieve probably in the last 10 years post GFC in terms of transforming the technology in treasury capital market space, COVID-19 has done that in a very short period of time. So in that sense, I think this crisis was a blessing to a certain extent. It's almost like in the forest, sometimes fire brings new life and brings the changes that can be positive. We've seen COVID in the same sense in terms of adoption of technology and kind of living behind the legacy technology and services. Prior to the crisis, even access to systems remotely was not the norm, and in most cases was not allowed. And we've seen in a short period of time where global markets like Singapore, Hong Kong went into lockdown, in a very short period of time, the institutions needed to adapt themselves to first open their architecture to remote access and also enable certain technologies that were previously used on a non-critical or mission-critical basis, but swift moved into production use cases. On our side, we've seen a significant change during this 3-month lockdown in Singapore with some of the financial institutions here. We successfully delivered 2 major projects, one in the area of UMR or unclear margin rules for the ISDA-SIM projects. Although the timeline of phase 5 was delayed for a year, we've delivered the project ahead of schedule thanks to leveraging from managed services using our AWS infrastructure. And I think this is a big change. Prior to this crisis, whenever we spoke with the clients or prospects, the use of the cloud, AWS, or managed services was good to have, but in most cases it was a medium to long-term view in terms of adopting this. Today, we see more and more demand and increased queries from clients to accelerate this adoption. To other extent, even as a technology provider ourselves, we've seen the changes. So as part of our operations in Singapore, we have quite a sizable team, and some of our services, especially in private banking space, is developed directly out of Singapore as being one of our open centers. We have closed our office ahead of the rules in Singapore. Actually, mid-March, we started working from home. As a global company, we've taken the decision that it was risky, and we didn't want to put our employees at risk. We've taken this decision and we moved working from home on a global basis with all our operations, including in Singapore, and we were able to do that. And what we've seen in the last 3 months, in some cases, actually increase efficiency and productivity as overall working from home. And one of the changes we will be adopting post-COVID is actually working from home policy on a global basis as a tech company. We see that people, when they're given choices and flexibility, they can perform better compared to traditional office environment and space. I believe post-COVID, all the markets will come to a new norm, but we will see some of areas, the traditional areas, in terms of how financial institutions as well as technology providers, service providers working with them, would significantly change going forward. And I think it's going to be a good catalyst in terms of separating the leaders in the space in terms of adopting technology, digitalization, a better client engagement model versus the ones stick with older forms and technologies and will be most likely left behind. So
okay,
maybe on, yeah.
Go ahead.
Yeah. So as we deal both institutions on the private banking as well as on the issuance or on the sell side, investment banking side, maybe I might ask some questions in terms of other panelists, how they see the change in terms of use of technology in the last 3 months and how they're looking at post-COVID-19, the changes that would be implemented or any changes in overall policies that they operate under. Maybe we can start with you in terms of what you see on your side, the use of technology and changes post-COVID.
Yeah, sure. Thanks for the question, Adam. So to be honest, I think, yeah, technology is something which we always talk about, and I think there's always the right intention to have technology working for you, especially in a bank. But I think the COVID situation kind of showed the mirror to our face, and we realized that we were not ready. So a lot of the banks, or most of the banks, underwent a very strong transformation in a span of maybe a month, which they would have done in a matter of years. And going forward, I think people also have realized that the world is not going to go back to normal. We are going to have a new normal where working from remote locations, technology playing a much important part in your conversations with the clients, but even client meetings when travel is not something which you can do freely. You will have to have client calls, over internet. So, given all that, technology is going to play a very, very important role, especially in terms of structured products. I think one of the side effect of this pandemic was, in terms of the structured products, was, as I said, that we have seen tremendous inflow of notionals in other trades for us, and it has showed us, at least in HSBC, the importance of technology. So we will be working both internally and externally to see how we can automate as much as possible when it comes to structured products. I think structured products can easily be divided into flow and non-flow. Anything to do with flow should be digitized, should be automated, and there should not be any human intervention. I don't think how many banks are, I'm not sure how many banks are ready to do that currently. But I think in the next 12 to 18 months, that part of the transformation is something which is going to be critical when it comes to structured products.
Thank you. Edward, maybe you can also share your experience with us in terms of how you adapted yourself in terms of use of technology and how you're looking at post COVID.
Yeah, sure. Thanks, Adam, for the question. Obviously, as what Ishan said, there's a lot of changes during this period, because for the client engagement stuff, we do have to maintain an active dialogue with the clients, and I think many banks, including our banks, was put into remote access, making sure that our phones are connected to even though we are not physically present in the office, so that we can pick up calls or from clients that calling us. I think that is, and also the fact that having the remote access, and I'm amazed that nowadays the technology is also pretty efficient. Even though there's a sheer volume of staff has to at the same time getting remote access to their computers, and it's actually pretty it doesn't actually slow the speed. So I think that is where what we experience that is quite good during this period, that we don't generally suffer from not being able to get in touch with the clients efficiently. And of course, from the structured product point of view, I mean, technology is definitely always important, and particularly when it comes to BEX execution, client suitabilities, that sort of regions where the regulators actually look quite closely, and technologies can help, for example, in terms of much faster price discovery, right, for any kind of popular structures, and digitalizations also can help, for example, to make the product documentations with a single click, and that actually helps, for example, for the frontliners to do their or fulfill their pre-trade obligations. And then also even on the post-trade side, given in Asia, a lot of products have lockout features, and the technologies may be able to pick up these sort of corporate events and quickly to inform the investment counselors, so they know what products in which portfolios actually being early redeemed, and that could also help the investment side to re-engage the clients and think about other ideas to redeploy the capital. So I think this is obviously what I talk about. This is not just these 3 months. I think it's an ongoing thing that I can see technology is very useful to support the structured product business.
Yeah, I think I agree. We're seeing a lot more focus on not just looking at the initial engagement point with clients in terms of offering these products, but more holistic look at in terms of end-to-end process, both during the pre-trade suitability checks, documentation, best execution reporting, but also post-trade services, including any life cycle events, dividends, coupon payment, knockouts, barrier monitoring, being more and more important. And if we cannot leverage from the technology, especially under the given conditions, there's going to be more stretch in terms of the frontline operators in the banks to deal with the ongoing requests. Terry, maybe you can also share with us on your side your views, how the use of technology changed and how you're looking forward post-COVID.
Sure. Thanks for the questions. To be honest, there wasn't a major technology change over the last 3 months because our systems have always been built for remote office. So I can still remember, the day lockdown was announced, and then we notify SFC about our BCP plan. And next day, we as sales are working from home. Even our traders are doing the market making of our warrants and CBBCs from home with no issue. I guess our company has always been investing heavily into technology and platforms and digitalize as many processes as possible. And one of the key area is on the usage of big data and analytics. For example, the vast data we can collect over our pricing platforms will allow us to analyze our client activities, to understand their preferences, which also enable us to get closer to our clients. It does help a lot in terms of initial idea generations. Then with the knowledge and experience of our professional advisory team, we will be able to further develop those ideas into actionable solutions that meet our clients' expectations.
Terry.
Thank you, Terry. Maybe I can also add from the, yes. Yeah, I was just going to see, maybe I can also add from the exchange perspective, because apparently same as all the other speakers here, the exchange also fully automated our most of our daily processes, and almost like 90% of our staff are able to work from home during the crisis, especially during the relatively social distancing requirement when they are applied in Hong Kong. So we use webinar, and WebEx is a very common solution for us to have meetings both internally and externally with the client, and remote work access using Citrus to work from home. And on the structured product space, actually, with the crisis, we see the importance of having a shorter launch timetable. Currently, it takes 5 days for a listed issuer to issue their warrants or CBBCs or inline warrants on the exchange. We are moving it to 3 days. We have shifted a lot of our manual process using RPA, robotic process automation, in order to make our BAU process more efficient and faster. So I think these are some of the automation that we have done in the last couple of months.
So you're really acting as a champion. So as we say, you're eating to a certain extent. Excuse for language, eating your own dog food. Not only preaching in terms of championing use of structured products, but also embracing digitalization, use of technology and automation in the process as well.
Yeah. Okay. Shall we move on to some questions from the audience, because we do have quite a few?
That's great.
Okay. Okay, so the first one is, what do we expect to be the main challenge for the structured product market in the next year? So I think, Ishan, can you take this question?
Yeah, sure. So, as I mentioned, I think this the pandemic is going to provide a lot of opportunities for structured products. However, I do think that there is one particular challenge which you will face in structured products is basically the low interest rate, and that's primarily because structured products can also be divided into a principal float and a non-principal float structures. Obviously, most of the structures which we do are the non-principal float, so your fixed coupon notes, your credit link notes, and equity link notes. But given where we are in terms of the market and our clients tend to be a lot more conservative, we've also seen a very strong interest with regards to the principal float structures. And unfortunately, when your interest rates actually go down, your principal float structures doesn't really work in terms of the pricing. However, we have seen a shift, amongst private banks and clients tackling this, and that's basically the coming of the warrant notes, which we have seen in the past couple of years. Getting clients to pay a premium has always been challenging, especially in Asia. But I think given that the interest rates had continued to be at a much lower rate post the GFC, it did bring the warrant framework into the picture. So it is going to be challenging in the next, I think the next few years, because I think the interest rates are going to be lower for longer. And clients are clamoring for principal float structures, cash alternatives. But that's a challenge I think structured products will face, and the way to go about it, tackle that would be using warrants, and hopefully we can educate clients to pay for those warrants.
Thanks, Ishan. There's another question. It's actually about the Easter theme. I think the extreme market volatility seen recently has highlighted a crucial problem in how often Easter theme is recalibrated. Does it make sense in its current form? And should greater sensitivity be introduced to the model? I think, Idam, can you help with this question?
Sure. If you look at these SIM in terms of the initial margin calculations, it's basically relying on sensitivities-based approach with a correlation structure laid over to kind of replicate a historical VAR approach. In essence, most of the institutions who is providing the best backtesting reports based on the historical VAR runs on their portfolio to ISDA is providing the information that is required for this recalibration of the model. I think what is lacking today in the market, in general, not all institutions going fully in terms of embracing technology and also implementing all relevant components in terms of these SIM. They generally go with a shortcut in terms of just producing sensitivities and being subject in terms of how the margin is calculated or being submitted. But more institutions adopt the full use of also backtesting framework. I think with the information collected by ISDA, the framework is flexible enough to adopt these kind of hikes that we see in the market in terms of volatility, not just during the COVID, but it might be also some other localized or global market events that we might see in the future.
That's There's another question about the risk management. Risk management has improved, but dividend crisis has unveiled hedging risk. Is there a danger of some players retreating from the market? So who wants to take this question?
Hi, this is Ishan. I can actually take that question.
Thank you.
So yeah, I mean, we have the dividend crisis has been something which has taken a lot of players by surprise. And for sure, it does affect as how you put on your head. But I think going forward, with the dividend prices what we see currently, at least from our point of view, we think that this is temporary. While it has had a significant impact on investors currently, we don't think that going forward that the dividend prices is going to prevail as such. There are certain products, however, which are linked to dividends. For example, the products on the dividend futures are. So these are payoffs which probably won't be as popular as it was in the past. But overall, we don't think this as a significant crisis or a significant risk, because we do think that eventually these dividends are going to come back in the shorter to medium term.
Great. Okay, so there is a lot of interest in digital assets. So do you anticipate future appetite from investors in Asia to gain exposure to structured products linked to cryptocurrencies already in an ever-growing interest of portfolio diversification?
I think a lot of it will depend on how regulators view cryptocurrencies. I think from the client point of view, sure, there are a lot of clients who do inquire about cryptocurrencies. So I think it has to be a step-by-step process. The first step is to actually for the clients to be able to access these cryptocurrencies in a properly regulated market, which doesn't exist, currently. There are not many private banks which would allow clients to invest in cryptocurrencies using the private banking platform. So I think that we need to, sort that out first. The second step would be to actually have derivatives on cryptocurrencies. While I do see that in the future, I don't think that's going to happen in the next, 3 to 4 years. So I think the most important part would be that we need regulation. We need a proper regulated market for the derivatives market to thrive, and also liquidity. Liquidity is going to be key, depending upon how much investment do we actually see in the cryptocurrencies.
So I see the regulatory evolution will be quite important in this space, right?
Yes.
Yeah.
Yes, absolutely.
Yes. Okay, so it's a very interesting point. Next one for Terry, actually, there is a specific question for you. Have you seen growing interest from investors for structured products since the start of the crisis?
Thanks for the questions. Definitely. I mean, during the crisis, what we have seen is, elevated volatility, as mentioned earlier, and also with the share price, adjusting down in such a short period of time. So from peak to trough, it's like 35% for S&P in a month. So we have not seen such unprecedented movement in such a short period of time. So lower price, higher vol, and that would create a better entry point and also better terms for the structured product. So from the March lows onwards, along with the market rally, we have seen a growing demand on structured products, especially those yield enhancement products along the way. And as the markets recover, you get more knockdown, you get more early redemption, then there's also a lot of rollover trades as well. So to answer your questions, yes, we have seen growing demand, and we believe that, as the structured products are very flexible, it can be made for different market conditions. We believe the prospects or the interest will be there to stay.
That's good. I think the same question we can ask Edward the same question as well. So, can you share your experience in the last couple of months?
Yes, Gabo, sure. I think that after the crisis, obviously, I think initially investors are, still relatively skeptical about the market could go. And I think that generally speaking, I think clients were not expecting such a V-shaped rebound in terms of the equity markets overall. But as we see the markets gradually moving back to normals, and there are investors looking at using structured product to enter markets, because as the volatility stay high, and you are not quite sure about what the markets could go, and actually the sell-vol type of products could give pretty decent buffer, and generally after such a sharp fall of the index level of 35%, if you look at some of the stocks actually go down as much as 60-70%, and then you have additional buffer from the already low level. It actually help or give more comfort for the clients to re-enter to markets. And also of late, how we observe is that as the market rallied for two months, and then investors are also thinking about whether there is certain possibility in the next couple of months, and may have some sort of correction in the markets, and there are some clients are worrying about that, and then there are some structural product is able to help the clients to maybe lock in the lower level of the entry point in anticipating 1 or 2 months if the clients do expect some correction. So I do generally see that there are pickup of interest in structured products overall.
Okay, thank you, Edward. Do you think this is relevant to the profile of Asian investors because they are more risk-taking?
I think certainly Asian investors are quite used to structural products, and I think risk-taking to a certain extent. I think it does help the structured products volume to be more flourishing in APAC. But I do somehow think that the risk-taking part not necessarily go into the more bullish structures. I think if the clients are more risk-taking, I would have expected that there are a lot more bullish structures being traded, but that is not what we observe, at least for our client base. So we do see that there are more income-based products that's being traded. So it is good that the risk appetite has returned. And I think this time around, the central bank has acted much faster to make sure that the liquidity crisis go away very quickly. So therefore, despite there is a bit of dislocation in terms of the economy vis-a-vis the financial markets, I do see the clients generally want to take some exposure back, risky exposure back in their portfolios.
Yeah, thank you. I think this is a very interesting observation on the risk-taking part. I mean, because like the Hong Kong Exchange, our listed structured products is the world's actually most active market in the world for the last, I think, for consecutive 10 years. So even though we only have only 3 products, currently we only have derivative warrants, callable bullback contracts, and inline warrants. Only 3 products, but we claimed the #1 title for the last 10 years. I think is partly also because the client base, the investor base in Hong Kong is very sophisticated. Since we first started the derivative warrant markets, I think back in 1994. So, and then we launched CBBC in 2006. That we're talking about almost 20 years of experience. So I guess the investors' sophistication plays an important part in pushing the structured product market as well. I think Ishan, maybe can you share your experience in the private banking space as well? what do you see about the profile of the Asian investors?
Yeah, I think it's a very interesting question. I mean, yes, agreed that the Asian investors are actually more risk-taking than the European American counterpart. But the other aspect to that also, I think, is the propensity for complexity. So I think Edward had a very good point that, the risk-taking doesn't really equate to the Asian clients going and taking bullish structures on their portfolio. But actually, they like the complexity in terms of rather than going outright cash equity, they actually use the yield enhancement products like fixed coupon notes. So when you do that, the moment you had an option overlay on your portfolio, it kind of helps mitigate the risk because it does give you a bit of a downside buffer. But to me, more than the risk taking, I think it is the propensity of the Asian clients for the more complex stuff, more complex payoff as opposed to their European and American counterparts is what may have helped them to navigate the crisis better.
Thank you. So I think that's the last question we have from the audience. So I think well, in closing, I think our panelists have today discussed not only the risks, but also the opportunities we see in the structured product market. While the market is fast moving and always evolving, I think we all need to be very creative and nimble and work together to weather the crisis and capitalize on new opportunities. So I think that concludes this webinar, and thank you all for your participation and for all the speakers as well.
Thank you. Thanks, Gabo. Thanks, everyone.
Thank you, everyone.
Thank you, everybody.
Thank you.
See ya.
See you.